Hello, today is the 26th of December, time for a market review. Once again, it's going to be released during the second part of the week, and this time it's because of Christmas celebration, and so yeah, that's the reason behind that. I think that the most important thing right now is a conflict. To be exact, we have a problem. On one hand, Fed is a bit more cautious now, and I'm sorry, what's moving here? It's dual moving. Okay, let's take a look. Dual. Trying to break out here. I don't like how spread it is, so never mind. So back to the data. Fed is a bit more cautious now, and that was because of another piece of macro data, which came in a bit hotter than expected. But for some reason we don't see. Oh yes, here it is. It's the PPI. It's producer price inflation month on month. So this one got Federal Reserve cautious and much more not in a rush to cut rates anymore. And 2 days later, we see this release where another index is better than expected. So what happened in the market is this maneuver. Let's take a look at QQQ. So yeah, this was the original release, and this was the bounce back on the December the 24th. Just let me check. And so that led to this bounce back. And this is a classic example of V-shaped recoveries. And V-shaped recoveries are usually problematic ones. Actually, the initial, not the initial, the legendary COVID bull market, post-COVID bull market was ignited with a V-shaped recovery. But in order to believe in it and to be early in it, you've got to be extremely confident with your read on the fundamentals. And this is usually not the topic I want to engage myself very much with, because when you torture fundamental data long enough, you can basically convince yourself that you are right. And in my opinion, conviction is the number one killer of investors on the street. So this rally did not produce any relevant buy points, but maybe the only one that goes well with my playbook is Tesla. On the day before Christmas, on Christmas Eve, this one I should have bought, and actually I'm not happy with the fact that I've missed it. But with the exception of that, it's not much to play with, even today, because today could be a good day actually, because we are supposed to be hangover from Christmas, and that supposedly that should produce some buy points for us, maybe some local corrections, and actually Duolingo is supposed to be one of them. But there are other things I don't like. About these setups. There are very few of them, and to make things even worse, this is not a valid accumulation day despite the big volume, because it was quadruple witching Friday the 20th. And we have a similar situation here. As you can see, this one was maybe the first one to trigger buy point today, but it didn't work so far. It's not a death sentence to this breakout attempt, but in my methodology I want them to go right away. So if I was to trade this, I most likely I would be already out of it. So what else? CrowdStrike is trying to do a very similar thing, and actually I like it a bit more, but once again, you can trust this accumulation bar. And what I really don't like is this wedgie pattern without any additional shakeouts. Usually wedging isn't considered a good thing in a technical situation like this. So, and with the exception of that, actually, once again, index rally, not much to do. And this is another one, by the way, I'm looking into, and it could be, I like this one a bit more because here we have a bit of a double bottom, but not ideal, but maybe one of the best among the ones which are present right now. And yeah, so that's it. This is one example of a company, of a stock, which actually worked well. So, but basically this is the only example of a good idea. The company is Cellebrite. I don't remember what they do. Maybe they produce spyware or something, if my memory serves me right. So that tells you a lot about the time we live in also. So yeah, this is just an overview of what I have in my watch list. I'm still trying to learn to trade situations like this, because for me it's always too dangerous and too volatile. Obviously, you can play them on an intraday basis, but I don't know, maybe this is one of the solutions to my problem of having few situations to trade due to my quite extreme how do you say it, wants from the market. I want the best of the best, and the best of the best are not aren't available in the quantities which are necessary to produce outstanding results. So this one I'm looking into too. This one we already checked out. What else? Yeah, I just wanted to take a look at Bitcoin. Actually, TQQQ is sort of setting up again here, so it's holding quite well on an index basis. So if it stays inside today and maybe tries to go to push back, to push further to the upside, it could be something I could consider for myself. So yeah, speaking about Bitcoin, what I really don't like here is that it's bouncing off this ascending 50-day line, and it's not ideal. Unfortunately. It would have been a decent support of the moving average if it stayed here, and if it could hold this confluence of 10-day and 20-day exponential moving averages, but that's just not the case. And I really like how Oliver Kell handles situations like this, because if this configuration of moving averages changes and 10-day starts to leave below the 20-day, actually it's bearish. And in my opinion, there is a good chance that it will go a bit lower from here. Which levels, I don't know, of course. Maybe it will undercut something, maybe it could undercut this level. What's that? That is, it's 90. Yeah, sounds like a reasonable support level. And what could happen if things go south a bit more? I don't know. Maybe this is the short price structure, so, and it rhymes well actually with this level. So that could be considered as an additional argument for this support. But if we will undercut that, basically not much separates us from this level, and this level is what is like 80, 7,700. I don't know. We'll see. Fortunately or not, right so far about my hypothesis that this time these returns will be much more, how do you say it, less pronounced, and it should be around 33%, because if you apply, when you divide this and this, you'll get the number you can apply to this, and you can sort of produce expected percentage return. And it's not that far from that. Of course, it was higher, and now it's actually, I think, exactly at the same levels. It should be like 53% from this consolidation should be like 98. So basically that's it for now. Let's see. We still have some time before the new year, so maybe there will be some interesting situational plays, because after New Year it's seasonally not the best time to trade, because the tax sales are nearing, but we'll see. Let the market tell us what to do.